This week in the world of big tech, a staggering spending figure took center stage, raising eyebrows and questions across Wall Street. While massive investment plans sent some tech stocks tumbling, one company saw its shares jump, only to be caught in a wider market downdraft. The reaction left many asking, did one company's AI success justify a spending spree that spooked its rivals? And can that momentum last? Welcome to TickerWatch News from Meta, Week 6, 2026. This week's developments from Meta Platforms were driven by its fourth-quarter earnings report, which revealed a massive new spending plan centered on artificial intelligence, a mixed reaction from the market, and a series of new legal and operational headlines. It was a volatile week for Meta. The stock initially surged by over 10% following its strong earnings report late last month, but it couldn't hold on to those gains. Amid a broader tech market sell-off, the stock reversed course. According to a report from February 6th, shares ended the week with a decline of around 9.2%, closing near the $670 mark. This sell-off occurred during a dramatic week for the technology sector, with the Nasdaq Composite finishing in the red as investors grew wary of huge spending announcements. The four largest tech companies, including Meta, collectively lost nearly $1 trillion in market value over just 5 days of trading. The dominant story for Meta this week was the announcement of a massive increase in its AI spending. The company plans to boost its capital expenditures to a range of $115 billion to $135 billion for 2026. This investment is heavily focused on building out the infrastructure for artificial intelligence. A key part of this is the expansion of its Hyperion AI data center campus in Louisiana, which reports indicate is growing to be more than twice the size of New Orleans International Airport. The spending is part of Meta's effort to secure the immense computing power needed for advanced AI, with the company noting its AI capabilities are doubling roughly every 6 months. These spending plans were unveiled alongside a strong fourth-quarter financial report. Meta's revenue for the holiday quarter reached nearly $60 billion, a 24% increase from the year before, which beat analyst expectations. This growth was fueled by AI-driven enhancements in advertising efficiency and higher user engagement. The number of daily active people across its family of apps grew to 3.58 billion. The company also provided a strong revenue forecast for the first quarter of 2026. At the same time, Meta is navigating several new legal and regulatory headwinds. In the United States, the company is facing an upcoming jury trial in New Mexico related to child exploitation claims on its platforms. It was also hit with a new patent infringement lawsuit from Solos Technology, seeking over $1 billion in damages connected to its smart glasses. In India, the nation's Supreme Court is closely scrutinizing WhatsApp's data sharing policies with its parent company, raising new questions about user privacy. Finally, on the product and sustainability front, Meta is reportedly testing a new standalone AI-powered video creation app called Vibes. The company continued its push towards clean energy, signing another power purchase agreement for a solar plant in Texas to help power its growing data center operations. The market's reaction to Meta's news was split. Initially, investors and some analysts reacted positively, with firms like Freedom Capital Markets raising their price target to $825, pointing to the strength of AI-enabled advertising. Unlike other tech giants that were punished for announcing big spending increases, Meta was at first rewarded as the market saw its investments directly translating into higher ad revenue. However, a more cautious sentiment emerged as the week progressed. An analyst at Needham warned that Meta is now priced for perfection and that its massive capital spending could squeeze operating margins in 2026. The firm suggested that if growth slows, the stock could face a downside risk of 10 to 15%. This cautious view reflects a broader anxiety on Wall Street about the sheer scale of AI spending across the industry and how long it will take to see a clear return on those investments. From a fundamental perspective, this week's news reinforces Meta's pivot to becoming an AI-first company. The argument that its capital spending is a drag on the business is being countered by clear evidence of monetization through better advertising performance and increased user engagement. Time spent on platforms like Facebook and Instagram is rising, and ad conversions are improving due to AI. Still, the scale of the new $115 to $135 billion spending plan raises legitimate questions about future free cash flow and the return on that investment, particularly as legal and regulatory threats continue to build. As for the stock price, after closing around $670, Meta has pulled back from its post-earnings highs, which were near $716. The stock is currently trading below the average analyst price target of approximately $860, but also well off its 52-week high of over $790. Looking ahead, investors will be monitoring for any further developments related to the new legal challenges in New Mexico and India, as well as the patent lawsuit concerning its smart glasses. On the product side, any new details about the Vibes app or other AI-powered features could influence sentiment. From a market perspective, a key price level to watch will be whether the stock can find support around the $670 mark, or if it continues to be influenced by the broader tech market's direction. The bull case for Meta is that its AI-driven advertising revenue continues to accelerate, proving that the massive capital expenditure is a smart investment generating strong returns. Bulls argue that Meta is successfully using AI to strengthen its competitive advantage. The bear case, however, focuses on the risks. Bears worry that spending over $100 billion in a year is unsustainable, that profit margins will get crushed, and that growing legal and regulatory threats could pose a significant financial and reputational risk that isn't fully priced into the stock. Thank you for tuning in to this week's episode. This podcast is for educational purposes only and is not financial advice. Be sure to subscribe, leave a review, and share this episode with others interested in the latest market developments.